Hey guys, Marcel here from Lewisburg Private Wealth, and I'm here with my colleague Rob Curry once again. Rob is with the investment team here at Lewisburg. So Rob, pretty interesting subject we have, active versus passive investment management styles. So what do you think?
Yeah, I think it'll be a good discussion. When we talked about doing this, you brought up some good points, so I think we'll have a lot of things to go through for sure.
Yeah, I mean, it's definitely top of mind or making a lot of headlines in the last, I'd say, decade in financial media. I know I've been having a lot of conversations about it, and the industry in general seems to be very interested in this topic. So I felt it'd be a good time for us to kind of dig a little bit deeper, look under the hood, and kind of explain what the difference is, what each bring to the table. So I guess let's start there. What would you say the difference between active and passive investment management styles or investment management vehicles would be?
Yeah, so I mean, if you back up a little bit and you look at the overall market, let's just kind of say this broad term, the market. So
Sure.
we'll talk about stocks specifically. The
Mhm.
stock market, I mean, everyone's talking about, is the stock market going up, going down? And what are we talking about here? Typically, we're talking about something like the S&P 500 in the US, which is an index that is supposed to represent the overall stock market.
Yeah, kind of like the
And
TSX composite here in Canada.
exactly, like the TSX composite here in
Yeah.
Canada. And the way that that index is created is it takes the relative size of all the top 500 companies in the US that are publicly traded and weights it based on the size.
Mhm.
So if there's a company worth 200 billion and a company worth 100 billion, then the one with 200 billion is going to have twice the weight as the one with 100 billion.
Which means it's represented twice as much in the overall index, correct?
Right, exactly. Yeah. So if you're investing passively, typically what your goal is to replicate that portfolio. So if you're going to passively invest in U.S. stock market, you're typically going to invest in an index like the S&P 500.
As close
And
as possible too, right? Is the
exactly, yeah.
goal.
So maybe you're doing it through an ETF that owns all of those basically in the exact same way that they are in the
Yeah.
index itself, so that you'll basically mirror the returns minus whatever the cost is of trading and holding that holding those funds there.
Which
You'll
means
kind of mirror
for
that.
which means for the investor, they're investing twice as much money in that company that's twice as large as the next one, right? So
Right. Yeah.
literally, you're at the mercy of the index, quote unquote, the market, to dictate where and how much of your money you're investing in which company.
Right. So anytime you take an active decision to move away from that, we now get into active management.
Right.
And so that can be very very few decisions to a lot of decisions, and we kind of have this broad spectrum of active management.
And it's kind of funny how a lot of, active management, if you will, products are kind of masquerading as passive, right?
Yeah, exactly.
So
Yeah,
not all ETFs, if you will, or not all marketed as passive strategies are actually purely passive. They have some degree of active within them. So there's a huge degree of active management.
yeah, and that's exactly right. I mean, there's actually a number that we use in the industry to kind of account for that, and so what we call it active share.
Hmm.
And really, this is a way of measuring the difference in your portfolio versus the index or the benchmark that it's
Right.
being measured against.
How active have you been?
Right, exactly. So when you make deviations in weights between, so if you're, for example, a quant manager and you're trying to manage a portfolio based on a group of factors that you think are going to outperform, whether it's the size of the company or momentum, or there's any number of factors that you've
Mhm.
chosen, you're going to build your portfolio and weight different stocks based on those factors, which is going to deviate from the passive strategy.
Sure.
If you're a fundamental manager, maybe you're using things like cash flow, business quality, balance sheet, and valuation metrics to do the same thing, to choose the weights. You're picking the stocks you think that meet the criteria that you've built, that are going to outperform this passive index in your opinion. And that's one of the really important things to mention too, is that active managers are typically measured against their passive index
Right.
counterpart. So if you're a large cap US stock manager, you're going to be measured against the S&P 500, for
Like
example,
measure it against, like, for performance
for
and
performance. Yeah,
risk, etc.
yeah. Like, have you done as well as that passive index?
And when it comes to performance, I mean, I think it's important to remember that performance should be kind of looked at as risk adjusted returns, right? Pure net returns is not enough. I think you need to look a little bit further than that for most investors, because risk does make up a large part of how investors experience, how investors want their experience to go. So I mean, and each strategy basically has a different approach to risk management, right?
Yeah, I mean, risk is a really important thing for us to actually kind of touch on, because risk plays a really big part in portfolio construction in general for any kind of active manager. And when we look at risk, there's the technical term for risk, which would be something like standard deviation or variance, which is the mathematical term. But there's other types of risk too, and we've talked about it before. But we have, for example, concentration within the indexes.
Right.
So, for example, if you look at Canada, the top 10 companies in Canada now make up 40%, right about 40% of the overall portfolio. So because they've become so large relative to the other companies, as we've said, that's how your passive strategy, that's how it's weighted. It's based on the size of the companies. So you have 40% of your money being put into these very, very large 10 Canadian companies.
Yeah.
And the number one of which being Shopify, which has had an incredible run, and I'm sure we'll talk more about that after. And in the U.S., we've actually seen a similar thing happen, and this is actually kind of unique right now for the U.S. because the S&P 500 has more companies in it, about twice as many companies as the TSX Composite, because there's just more American companies than Canadians.
Which is surprising because S&P has always been recognized as a very broadly diversified index, right?
Right, and that's why this is kind of more of a new issue. But now we've had the top 10 names, which were maybe 2 years ago about 20% of the overall index, now being at about 30%. So you've seen an increase in concentration and really it's been pretty steady at 20% for a long time. And it dipped a little bit below that several years ago, but it's really been consistent there. And we've seen this just recent pop up to 30%.
So as an investor, you're putting a lot of weight, a lot of trust, or a lot of confidence behind those 10 companies, right? So a lot of your money is invested in those 10 companies and a lot less invested in the other 490, if you will.
Yeah, and a great way to highlight this type of risk too is to think about bond universes. I mean, if you look at a bond index, what you're actually seeing is, the weights are decided by the amount of debt outstanding. So if you look at a corporate bond index, you're going to see the largest weights being at the level of the issuers that issue the most debt. Now, larger companies do typically issue more absolute dollars worth of debt just because they're larger companies. But you also have the more indebted companies issuing more debt because that's what it means to be more indebted.
So if you have two companies the same size, one with more debt, one with less debt, you'd have more of your money in the company with more debt.
Exactly, yeah. So active management has typically been much more desirable in debt markets just to kind of get rid of those types of issues. Mm-hmm. And so this gives you all the different types of ways you can kind of slice and dice how you want to look at this index, right? And so and even looking at Shopify, if you're going to passively use a passive strategy investing in Canadian equities, and you buy an ETF that mirrors the TSX Composite, for example, then you're putting about 7% of your portfolio in one name, being Shopify, that has had the run of its life. I mean, this has more than doubled year to date. And it's done extremely well over the past several years.
Oh yeah.
And if I was an active manager and I own Shopify, maybe I've been selling it as it goes up and kind of taking some profits. But you don't get to do that as an active manager, as a passive manager. Sorry. Yeah. You continually just hold that stock after it's run, and you hold it at that weight.
And an active manager would probably actually be proactively trimming as it's having so it's not a matter of not being in a company like Shopify. It's about managing the weight within the portfolio of a company like Shopify after it's done what a company like Shopify has done. Right?
Exactly. Yeah, and that's exactly right. So I think the best strategy, it really depends on what do you believe about the market. And I mean, like, you and I have talked about that, but you know what I mean? So
I definitely believe that when it comes down to which one is best, active or passive, I think you have to sit down and take a step back and look at, what do you believe? Do you believe markets are efficient? Do you believe that a company like Shopify's weight in the index is warranted based on the company itself? Do you believe that the market is great at distributing information and making sure that every company is perfectly represented? Then a passive strategy can make sense. But if you believe that there's dislocation, and if you believe that some companies can be mispriced or that unfairly represented in an index, etc., then active can make sense because that's where the opportunity lies. There's no way to beat a benchmark or an index without being active. We talked about active share earlier, right?
Yeah, and that's exactly it. So I think like going along that, I think the best strategy for an investor, someone who has wealth and looking, am I going to use a passive strategy or use an active strategy? Is if you, let's say, for example, you currently have an active manager that's managing a portfolio. I would just sit down with them and really try to understand what's the process they're using to pick stocks and to make sure that the stocks that they're picking are truly going to be outperformers and are going to offer great risk-adjusted returns.
Mm-hmm.
And if you feel very comfortable with how they're describing it and they're really bringing you along, I think there could be a beautiful partnership kind of created between you and that manager. And it can be a really good thing where you can understand how they're working to make sure they're controlling risk and at the same time how they're investing well. And I think that creates kind of a much healthier relationship rather than, kind of blindly trusting active managers or blindly trusting passive markets. Yeah. I think this kind of partnership idea is really where you get the benefits, all the benefits with less of the issues.
Yeah, I think you hit it on the head when you said that you have to have that risk component in that discussion, because I think for most investors, most people with wealth, or most investors in general, risk management is a priority. There is a certain investor experience that they expect, or there's a certain time horizon, or there's constraints around their investment goals that make for risk management being a big part of the expectations. So I think that's very important to consider. So let's leave it there, Rob. I think we covered a lot of ground. So till next time.
Sounds good.
Cheers.
All right. Cheers.
Bye.